So today's topic is about strategies for volatile markets. We are going to discuss some information today, and please make sure that this is not a trade recommendation or any sort of advice. This content is just for information purposes. A lot of insights and information I'm going to show you today, it will be for your information purposes. And if you have any more queries before entering into any live trade, please talk to your risk experts. Financial markets, by its very nature, are extremely risky, and it's really important to identify your risk appetite before you invest into any of the products. So without further delay, today we are going to discuss about what strategies we should have in volatile markets. And before we reach there and look into a few ideas, let me show you how the, or let me make you understand how the volatile landscape has been historically, how markets have been very very volatile. I'm going to use a live platform over here today, which will show you the live pricing of the S&P 500, which is a US stock market index. And it is also going to throw some light that how volatile the markets can be over a period of years. And once we understand this historical landscape, a few statistics and numbers which I may not show you on the chart, I'll be able to recite and tell you that how it has worked out. And once you understand the landscape of volatility, we'll discuss about what strategies we can use, right? So go ahead, guys. I think a lot of you have already started asking some questions about the product. So I think a lot of you have been writing so far. Please let me know any more questions if you have, and I'll be able to answer all the questions. What do you mean by volatility? Well, very important question since we are talking about volatile markets. So, volatility basically means the fluctuations which happen across the price movements. Because whenever we talk about price of a stock, how many times we have heard this, that stock market is too risky or forex market is too risky. Why we call it too risky? Because the fluctuation in the price is so real time, is so intense, that it becomes really unpredictable and difficult to decide whether to buy or sell. So as I said, I have the live platform with me. I'm going to show you right here real quick. Let me just share my screen with you. I hope everybody can see this. Just close this out. Perfect. Okay, so what you're seeing is the live platform right now. How many of you can see this platform very clear? Please, yes, write a yes or okay. This is my way of actually interacting with you, because I know I cannot see your faces or hear your voice. So please use your chat options. If you can hear me, if you can see this platform right now, do you want me to zoom in, or is this fine? Okay, okay. Right, we can see. Perfect. I think everybody can see it. Great reactions, everybody. Thank you so much. Everybody's writing real good. Perfect. So, as I said, volatility is the fluctuation in the prices, right? And it's important for us to know what volatility actually is, because as we know, and let me show this to you. Let's take an example of gold. Everybody knows gold. Gold is favorite for everyone. Every trader, every investor looks into gold prices. And currently, you can see that gold prices have moved from 1927 today, the lowest. Let me just zoom this for you. The quote panel right here. Yeah. If you see right now, the price of gold is 1945.76. Within this, if you see, the lowest today has been 1927. I'm going to show you this price movement just in last 4 hours, and or let's say in last 2 hours. Look how fluctuating the gold has been since morning, somewhere around. If you see this, just have a look at this. This is brilliant. Just look at this. So gold was around 1904, around 14th of September. 15th of September, it climbed to 1927. And then today it has climbed all the way to 1944. So in last 5 days, gold has went up by $45. This is the movement, and look at the fluctuations today itself. If I were to convert this chart and show you 30 minutes how gold is moving, look at the price movement every 30 minutes and you'll be surprised. Gold just moved in 30 minutes from 1934 all the way to 1943 and continues to go 1944. In 30 minutes, it went up by $10. And this is just gold. If I were to show you how NASDAQ, which is a US stock index, moves, look last 30 minutes, like look every 30 minutes of the movement. See how fast it falls and then how fast it goes up. Just have a look at this. Look at this. This is 19th of September, 15 233, 216, 188, 151, 15,095, 15,080, and then again bouncing back today to 15,240 levels, which was the resistance for yesterday. So idea is that the fluctuations are nothing else but the price movements which happen on daily basis, and it's a very important thing, because if we don't know that how much fluctuating the market is, how volatile the market is, we will never understand how much to buy or how much to sell. I'll give you an example. If today we understood that gold prices have moved from 1927, right? Today gold price has moved, lowest is 1927, highest is 1943, which means that gold has moved very easily around 15 $16 today, and the day has not ended yet. US has just opened 1.5 hours ago. So, and talking about is the importance of an event. Today, there is a Fed press conference, which means Central Bank of US is going to talk about the interest rates. This has been one of the primary reason why markets have fallen down in last 2 years. So, as I said, to give you an idea of how a historical volatility landscape looks like. So, I'm going to go, this is a live chart of NASDAQ. So, I'm just going to go a few years back, 2 years back to be specific. So, to give you an idea of what has happened post COVID, right? So ideally, of course, I must tell you a brief history of how markets have been. So just to share with you, uh, because few things we can look in this chart, few things I can actually tell you what how it has actually worked out. So to give you an idea about the landscape of how volatile the markets have been, it's really important to understand the key events and the trends or the factors that have shaped the markets over time. So and we have to understand that there were a lot of investment policies, there were a lot of situations which impacted. Like if we talk about the early financial markets, uh, when the markets actually started developing, how the stock exchanges in the very beginning were developed in Amsterdam, in London, and in a lot of major cities. And during this particular time, market volatility would just lead to market crashes or extreme increase in the market. So there, the bubbles were very common during the early phase of the financial market, because people had very limited knowledge. The source of information was very less. So if the price of something would start increasing, everybody would just buy. So the volatility was very, very high. It would either be in the form of high bubbles or lower market crashes. And then by 19th century, we saw industrial revolution happening where there was a lot of technological advancements. Now, technology actually influenced a lot to financial markets. And that was the time where we saw a lot of panic and a lot of rise in technology, a lot of volumes coming in. And industrial revolution was one of the significant time which made volatility much more higher, because a lot of traders and investors jumped in with technology coming in. Then between 29 and 1939, we saw Great Depression. We saw that how housing prices fell down across all the states of US. Financial markets were affected. Stock market crashed in 1929, and that's why they call it the Great Depression era. And post World War also, we have seen after the World War ended, the first and the second, the stabilization of financial markets, especially after the World War II, and the period of economic prosperity which came. I think that was one of the significant times when the markets actually started getting noticed. And in 70s and 80s, we should not forget about the oil crisis which happened, because globalization and rise of MNCs actually influenced the market dynamics a lot. And we should not forget between 90s and 2000s how the rise of the dot com companies actually created a bubble and everybody started investing into tech companies. um, I was reading somewhere that there was a time when any company would just put dot com by the end of its name and get listed for the IPO and gets fully subscribed because it's a dot com company. And that could be a restaurant, it could be a construction company, but just because it was followed by dot com, people would just buy thinking that it's technology. And that gave rise to a big tech bubble. And in 2001 we saw tech bubble bursting, and all the tech stocks started coming down. And that was the first time people actually realized that technology is something which cannot be played around with. Tech stocks or dot com bubble actually for the first time made investors realize that technology, not all technology is good, and not everything which follows the prefix .com means technology. So and again, when this happened, this was also a very significant period, because this gave rise to a lot of regulatory compliance parties to join in and make rules much more stronger. But then little did we know there was another bubble which was waiting in 2007 and 2008, which was also called the period of global financial crisis, where the real estate prices across US crashed, Lehman Brothers filed for bankruptcy, all the bigger banks were close to the bankruptcy, and the biggest financial system in the world was so close to the collapse. It almost collapsed, and it spread a recession across the world, as we call it, as a global financial crisis. So during the time, that's when the central banks actually got involved and reduced the interest rates and injected a lot of cash, a lot of dollars in the economy. And that gave rise to something called quantitative easing, which basically meant injection of more and more cash in the economy. So fast forward after 2008, once the economy got stabilized, 2015, we saw interest rates finally going higher from US side. The loans started becoming expensive, so that the excess cash in the economy can be removed and inflation can be controlled. Everything was going on as per the economic phases. And then 2016 Donald Trump became the president, which was, so 2016 to 2020 was a very significant time for the markets. Let me show you why. um, if you see this right here, you just zoom out a bit, look at this period from 2016 to 2020, and I'll just point to this here. This is where Donald Trump became president, right here. Exactly right here. And for another 4 years, this is what the stock market looked like, if you can see. 2018, during the trade war, we saw slight decline, but then continued. Right here, 2018, and then 2019 again slight decline, but then again went up 2019, and then finally 2020 here. So these 4 years, markets rallied, especially the tech stocks. They just continued to rally until the pandemic happened, which brought stock markets down right here. And again, there was a steady recovery. But by this time, Donald Trump had already been removed as the president. The people took their decision, and we saw 4 years of market rise, eventually a decline, and then again market started going up after COVID vaccines came. So as you can see, the volatility is something which has been the part of markets, and it is only getting more fierce because now the sources of information are too many. Every news which is out there impacts stocks, commodities, currencies, and there is a lot of influence from everyone. Plus, I have been in this industry for more than 15 years now. So what I have realized, that earlier a lot of investors were not interested in actually learning or understanding how markets work. But with rise of technology and exposure and more discussion about these things, now investors would like to know and would like to learn about trading or investments. So that has given rise to much more volatility, much more involvement, and much more discussions and theories. So that's why it's really important to have a strategy during volatile markets, right? So as we have discussed about this, how the volatile markets have been, now we have to understand can we reduce this volatility. Actually, we cannot reduce the volatility, but we can reduce the impact of the volatility on our portfolios. We can reduce the impact of these fluctuations on our portfolios by using different strategies. And one of those strategies is called a pair trading strategy, where you buy one and you short sell another leg and try to create a neutral impact. How many of you know about short selling? Just write yes or no. Anyways, I'm going to give a small description, but use your chat options, guys. Write yes or no. Do you know about short selling? My question is, do you know about short selling? Have you heard this term short selling? If you have, and if you know how this works, write yes. And if you don't know about it, absolutely no idea, you can just type no, and I'll be able to understand. Okay, okay. I've got a lot of yeses, few no's. Perfect. I'm going to give you a very quick example. And of course, I'm available after the session one on one if anybody wants to discuss more about short selling. But just to give you an idea how actually short selling works. So let's take example of Nasdaq right now. It seems like it's coming down. So if short selling is basically trying to take advantage of the falling prices of stock, commodity, index, anything you feel that the price of something is going to come down. How can you take advantage of this? And in a lot of trading platforms, you are actually allowed to borrow the stock or the commodity from the broker. Like for example, let's take example of Apple. If I'm sure everybody must have seen the iPhone 15 launch, and stock fell after that. If you so, for example, if you feel that iPhone 15 was not a great addition, or you feel that it's not going to be sold in the way other iPhones have been, and the stock might get affected. So you are basically anticipating that the stock price might come down. So in that case, what you can do is you can basically borrow any number of Apple shares from your broker, and just click sell in the market, place your order. Now you end up selling Apple shares. How you can sell something which you don't own? You basically borrow it from your broker and sell it in the market. Now, if Apple price comes down, you will be able to make profit from the falling Apple prices. This is what short selling is. How normally a transaction would work, that you buy something and the price goes up, you make profit. But in short selling is reverse. You borrow something from your broker, you borrow that stock or index or commodity what which you're expecting it's going to go down, and you borrow this from the broker, sell it at the market price, and price drops down, buy it back at a cheaper price, keep the price difference with you, which is your profit, and give back the stock or the commodity back to the broker. It's just a reverse transaction. Now, the point is why we are talking about short selling, because the volatility or the fluctuations we talked about means that either the markets are going to go up or they are going to go down. Fluctuation in the price is this, right? Either a price can go higher or it can go lower or can just stay, but mostly it will move somewhere. Sometimes high volatility, sometimes low volatility, but there is always going to be a fluctuations in the market. So if price goes up, you should have something which should be in profit when price goes up. If price goes down, you should have something which can earn from the falling prices. And we all know that short selling is the process by which you can take advantage from the falling prices. So in a pair trading strategy, to reduce the impact of these up down fluctuations, you buy one instrument and you short sell another, so that market neutral can be achieved. Now, which instruments are these? I will give you an example and tell me if you don't understand it. I will explain it to you again. Let me show you. Now I'm going to take you uh, to a different screen. Okay, let's say okay, perfect. Let me start with, yeah, let me start with this particular thing. This was the portfolio which we started with, but let me show you a pair trade over here. So I'm going to give you an example of something very easy. So let's take luxury is timeless. For example, this was one strategy which we did before. Again, as I said, guys, any information I'm giving you right now is not a trade recommendation. Please first understand this information, and if you feel that this is something which you want to execute, talk to our risk consultants first. These are some previous ideas. As of now, it's not necessary that it is valid in the current time period also, but this is just to illustrate how a strategy looks like and how you can try to do market neutral strategies. Now, when you look at this flyer and if you read it closely, while stocks like fashion tend to go in and out of favor, world's top luxury brands are made to last. Prime reason behind these brands' success is the massive barriers to entry on the supply side. Heritage is one of the many factors that have enabled the world's luxury brands. So most of the top brands have their roots in France, Italy. Louis Vuitton, Cartier, Hermes have been around for more than 150 years. Gucci celebrates its centennial this year. Besides a growing population of young, affluent consumers, increasing social pressure continues to buoy luxury goods demand. Now, historical analysis revealed that these luxury brands, they are very resilient, and they always come back after an economic downturn, because the luxury shopper never really goes away, and instead of picking five items they would probably buy two things. And this behavior was very evident in previous years, 2020 and 2021, where luxury stocks staged a brilliant rebound and then outperformed all the European stock index, European benchmark indices. So, and the same story, as you can see in the flyer, it says it was witnessed in the year of financial crisis 2008 and in 2009 also. Now, what was basically the idea? The idea was that you can participate in the luxury market and try to minimize the losses through a pair trading strategy. How you are going to do it? You buy a luxury lifestyle index, so basically a basket of companies which are based on luxury lifestyle, and simultaneously short sell the Euro Stocks 50, the index, Euro index. Because what we realized was, I'm going to show you this chart, and this chart is from 2008 to 2023. Just have a look at this chart, okay? And just see this. Look at the yearly performance of the luxury lifestyle index and the Euro Stocks index. Look at their return. In 2008, luxury lifestyle fell down by 39%, Euro fell down by 44%. 2009, luxury went up by 43%, Euro went up by 21%. 2010, 54% gain, 5% loss. If you see, just look at this chart, and I will keep this on. Let's try to find out how many times luxury lifestyle from 2008 till 2023 has actually outperformed the Euro Stocks Index. And when I say outperform, it means that, I'll give you the first example. Luxury lifestyle went down by 39% and Euro stocks went down by 44%. So in this case, luxury lifestyle outperformed in negative returns because it was less. In positive, whichever luxury lifestyle has 43%, Euro stocks is 21%, so luxury lifestyle outperformed. So I want you to have a look at these first two columns and tell me how many times luxury lifestyle over the period of 2008 till 2023 has actually outperformed Euro stocks. You can type your answer here. Just look at this. I want you to understand this on your own, because obviously I'll be always there one on one to teach you this. But once you have a look at this strategy, I want you to understand the foundation of this. Once you realize that how frequently one asset outperforms another, all of a sudden it becomes logical to buy one and short sell another in a market where fluctuations are very common. So just have a look at the first column, look at the second column, and tell me how many times you see luxury lifestyle basket has actually outperformed the Euro Stocks index. Euro index is basically European stocks combined together, and luxury lifestyle is a luxury specific companies combined together. Both are different baskets. So while you do this, I'll also calculate. Okay, are you done? You can type your answers now. So all you have to see is first column and second column and tell me how many times in last 16 years luxury lifestyle has actually outperformed. Out of 16, how many times? Okay, answer started now. Thank you. Okay, 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 right, okay. One question, what do you mean by outperform? So, as I said, outperform means that if luxury lifestyle earned a return of minus 5%, Euro stocks went down by minus 10%. So, here luxury lifestyle outperformed. So, that's even on when the prices are going negative, asset which went negative less as compared to other, it outperformed. In the increase in prices, the index which went higher more than the other or the previous one outperformed. So out of 16, I want to know how many times this luxury lifestyle actually outperformed. Okay, okay, okay. Perfect. Great. I think all of you have answered around the same number. So I'll show you 2008, yes. 2009, yes. 2010, yes. 11, yes. 12, yes. 13, no. So 13 Euro stocks went up by 18%, while luxury lifestyle went up by 9%. 2014, yes. 15, yes. 16, 17, 18, 19, 20, 21, 22, no. There was a difference of 1%, but still Euro stocks outperformed. Now, as you can see, in last 16 years, out of 16, 14 times luxury lifestyle has outperformed year on year with Euro stocks. So if you just bought luxury lifestyle and short sell Euro stocks, you would see that most of the time where their individual returns were negative, right? See 2008, for example. If you had only bought luxury lifestyle, or if you had only bought Euro stocks 50, your net return would always be negative. But if you bought luxury basket and short sell Euro stocks, you would make 5% net return, because you would lose in luxury lifestyle 39% because you were on the buying side, but you would short sell Euro stocks 44% and price drops by 44%, so you make return. So 44 minus 39, 5%. Like this, if you have a look at it, every time there is a negative return in either of the indices, if you had done this strategy, you would end up making most of the time positive returns, barring two times, right? So the idea is, during this entire strategy, while you are actually buying and short selling, you will not be caring about what happens to the European market, because you are on the bias of one and short sell of another. Now your entire focus is not on how European market as a large index performs. Your focus is on how luxury and the Euro stocks, how whether they will be able to outperform each other or not. So you are buy on luxury, so you want luxury to outperform the other one. Now this is where we get in, the pair trading gets much more interesting, because it's not something which you can just do over stocks. You can do the same thing in commodities. And currently, so we will provide you demo accounts as well if you ask for. And this is a very recent strategy which has come today, and you can try in your demo accounts, because demo accounts is money is just plastic money, so no harm done. Let's say, let me show you right here. See this. So we are talking about a commodity based pair trade, and as I said, this is one of the best strategies and ideas we have seen back in the past uh, for commodity based market. As we all know that oil prices have been very fluctuating, and oil prices also move a lot. So there are two kinds of oil. One is called Brent crude oil, and one is called West Texas crude oil. So Brent oil is concerned with Saudi, Russia, European, the international benchmark, and US oil or the West Texas oil is the US oil. Now, the strategy between Brent and WTI is actually very interesting, because if you check the price of both Brent and WTI, let me quickly share it with you, the platform again. So I'll switch it to the platform to show you the price of Brent and WTI. Now, if you have a look at it, look at the price difference between both, somewhere around 3 or 2.5 or $2.6, right? Now, the strategy which we are looking at to reduce the impact of volatility on your portfolio is by buying or short selling either one of them. And this time, the speculation will be done on the price differences rather than on the actual price of oil. And that's where it becomes actually very important, because now I will take you back to the flyer. Now, if you just have a look at it, so I just showed you the difference. It was around 2.5 or 2.6. Now look at this. Currently, the difference between both the oils is around $3.1. So this chart, what you see, is not the chart of the prices of crude oil. This is the chart of the difference between the crude oil prices. So the same difference which you saw, which is around $2.5 or $3 currently, this is where it is. And as you can see, that back in the past, this difference has gone as high as $11 also, and has also ranged around $8, $6. So the pair trades over here mostly happens around expecting whether this price difference will increase or it will reduce. Over the past 3 years, this price difference between Brent oil and WTI has experienced high fluctuations. Reaching lowest was minus zero point 0.6, which means at one point of time WTI was more expensive than Brent. Or the other side, on the higher side, Brent went $11 higher than WTI. Now, when we see that the chart, it's around 2.2, $2.3, right? And expected that it might go higher. Now, the idea is to take advantage, and if we expect that the price difference between both the oils will go higher, what we do is we buy Brent oil, which is expensive, and we short sell WTI, which is less expensive. Because currently, and just look at this, the price difference between Brent and WTI is this much, right? Let's say $3. And if we expect that this difference will increase, it can only increase if Brent goes up or WTI comes down, right? Now, this is where instead of worrying about the oil market prices, you buy Brent and short sell WTI, expecting that if the gap between them increases, that's where your profit will be. And if gap narrows, that's where your loss will be. So strategies are firstly pointed to reduce the impact of the following market on your portfolio. Today, if you take a naked trade on oil or put a stop loss, you're still influenced by or your portfolio is still vulnerable to the idea that if oil prices go down, you will lose money. But when you do this strategy where you buy one and short sell another, you actually don't care about where the oil prices go. All you care about is the difference between the oil prices. So a lot of hedge fund managers, they employ these strategies during the volatile times, and we have seen, as you can see, if Google Brent WTI spread chart, and you will see that there have been people who have been keeping records of 20 years of what is the difference between two oils, because a lot of people, they do trade with something what they call it as a spread trade. Similarly, this relationship has been established between gold and silver prices also in a form of gold silver ratio. So, guys, these kind of strategies are always helpful. Now, I did one. I showed you one in indices. I showed you one in commodities. Before leaving, let me show you one on bonds also, because right here, this is also something which is new, because a lot of people, they know how to buy bonds, but sometimes there are a lot of things which you can do with bonds as well. And here, as I said, that today is the central bank meeting where Central Bank of US will talk about interest rates. Do not miss out the press conference at 10:30 p.m. It's going to be impacting stocks, commodities, currencies. So keep a watch. 10:30 Dubai time. You'll be able to witness a press conference on Bloomberg or on YouTube where the meeting is happening in Jackson Symposium, and you'll be able to see it live. And do hear the remarks of the Fed chairperson, because whatever he speaks will determine the course of markets in the next by the end of the year. So that is something which is really, really important. Now, the last strategy which I'm showing you is a pair trade on bond, T bond ultra and T bond spread trade. So basically, T bond ultra is a future contract, which you can basically see in online trading, and you can see in online platforms. It's a future contract, and it tracks the 30-year bond, the longer dated bond, right? Now, historically, it was observed that a short term and a long term bond between the products, the spread or the difference between both the bonds was X amount, let's say, right? And the normally in last 13 years we have seen that this particular difference now has reached to a level from where it can bounce back, because a sharp rise in the US rates was one of the primary reason that prices went down and the yields went up. And the difference between these bond yields, again, uh, I'm available for a detailed explanation on how bond yields actually work and what they are. So as I said, that this is just for the information purposes, and do not execute any strategy without talking to your risk experts. So the idea for this particular strategy is that because Fed has been aggressively increasing the interest rates, the bond yields have gone up, and now when Fed has decided to hold on to the rates for longer, then market expectations are primed for recovery in the overall difference. Now, this can basically, what you have to do in the strategy is you buy US Treasury bond ultra and short US Treasury bond futures. So you basically buy the longer dated and short the shorter dated. And this will be done with the equal exposure with equal value. And the idea behind the strategy is a lot of people, they buy and sell bonds, but they don't really know that there is a trading strategy also in bonds which can be uh, taken, and that will allow your portfolio to be less impacted by the movement in the bond market, right? So again, as I said, there are a lot of strategies which you can use during market volatility. Pair trading is something which is, you should definitely talk to your risk experts first before you take any trade, because at the end of the day, it can be very risky. These are not risk free ideas. There is absolutely some amount of risk, but obviously there is a lot of statistics involved. So we always sit, understand your risk exposure, understand the invested amount, and only then you should be doing these kind of strategies, right? Somebody just asked how can I get a demo account, or can I use these strategies? You can use these strategies in demo account and see if this works for you. Just talk to your RMs and they will present you a demo account. If you want to learn how to use that demo account, please let me know. Fix a meeting with your RM and we'll teach you free of cost how to use the platform, how to put this strategy. As I said, that we are very much open for knowledge sharing and informative purposes. So if you want to know any how to use the platform, how to put these strategies into use, we are available in our office on Microsoft Teams or Zoom, whatever platform is good for you, and we are more than happy to discuss this with you. Right. So. um Another question here is, what do you think about the Fed decision today? Today's decision is important. However, I must tell you that a lot of analysts have anticipated that central banks are going to keep the central bank of US is going to keep the interest rates on hold and not increase it. As per the previous meeting minutes, Fed already said that they would keep a check on data, but they still want inflation at 2%. So I feel that rate hike will happen in the future. Maybe not too aggressive, but it will happen because the inflation is still not down to 2%. Ideally, before the meeting, we have seen that gold prices started moving higher, stocks were slightly higher. Now there is a lot of profit booking, or markets are retreating back. When the interest rate decision comes at 9:45, and if the Fed has decided to put rate on hold, that should push gold prices higher and stocks higher. But then 10:30 press conference will start, and press conference, in that the questions will be asked with Jerome Powell about uh, what is the expectation for the future and how aggressive they are going to be in increasing rates. And it will depend a lot on that press conference, that how the markets move. So do not miss out on that. Currently, if you ask the analysts, have most of the majority of analysts have expected a rate hold rather than a hike, which could push gold higher and stock markets up. And as I said, if there are no surprises, so keep a check on markets. 9:45 interest rate decision Dubai time, and 10:30 p.m. will be the FOMC press conference. And do have a look at it. It will be available on YouTube as well, I'm sure. So, and more than that, if you have any questions about this session, and you want to have a training one-on-one, and as I said, these are free of cost sessions, you can join anytime. You can visit our office in Imar Square. We are more than happy to sit and do a training session for you. And I will be personally available. I'll be able to guide you over the platform training and discuss all these strategies which we have talked about today, and how you can employ this in your portfolio. Right. So once again, thank you so much for giving your time. Yes, we do these webinars every week. Somebody just asked, we do these webinars every week, and we do this on different topics. So next week it will be a different topic, and we'll make sure that we come up with something more and more interesting, and more strategies which can help you understand the volatility in the market, and also help you to navigate through these volatile markets. So please follow our YouTube channel to see previous recordings of these webinars. This webinar will also be, it's already recorded and will be put on YouTube. And you can see a lot more content there, and any information you require, you can directly reach to us, and we'll be more than happy to help you. So once again, thank you so much. You have a good night. My name is Yogesh, and I'll see you next week.